This is why I invest in profitable businesses only as a general rule of thumb. And when I say that, I basically mean that 95, 99% of my investments are in profitable businesses. And and when you look at it, actually, only about a quarter of businesses listed are actually profitable in the market. So, significant amount more opportunities you could argue that are unprofitable, right? So, why have you filtered your universe down so much, David? Is one thing that you could argue, right? Well, and I think this reason is one which a lot of great investors sort of do for the same reason. Whilst it's obvious, there is obviously higher risk, right? I think everyone knows that money losing businesses carry more risk if anything goes on for an unsustained period of time, but it's the consequences with that as well. So whilst you could have significant, and I previously in the past have made good money investing in businesses where they've gone from unprofitable to profitable, flipped over and actually done very well on that, right? But the issue with that lies is that, well, there's a few things. Usually these types of businesses are fast growing types of businesses, but they also trade fairly rich, right? A lot of the time. And it's harder to oftentimes distinguish that when you've not got PE multiple to slap on it, right? Because that sort of grounds you a lot more in reality. And what that can oftentimes mean is that these businesses, whilst they're unprofitable, their valuations can oftentimes come down significantly just as the market sort of interpretation of them shifts. So, for example, the market could favor high growth businesses, even if they're unprofitable, versus sort of it could then a year later shift to profitable businesses. And that's oftentimes where myself in the past having been caught out, right? And multiples compress significantly. You see businesses that will, one day trade at $100, the next year they're at $25 for this very reason, if not even times falling beyond that. That's the first one. I'd say that's fairly obvious. But then what happens after that is, well, you're left with a few decisions, which is A, if you sell it, what that means is that, well, okay, you've taken a loss, fair enough. Let's say your next investment's going to do great. If you've taken a 50% loss, that means you need to make 100% just to get back to where you were. So not only do you have to then double your money, so your loss is significantly more significant than your profit, right? To get back to the same position. On top of that, your opportunity cost during that period is significant, right? Especially if you're a good investor. If you've taken a year and a half out of the game or 2.5 years out of the game just to get back to square one, you've effectively missed out on, if you are able to compound 15-20% per year or higher, right? You've effectively missed out on something like 50-60%, even more worth of gains. So you not only have you had to double your money, you've then had to go up another 60% just to get back to where you sort of would be on track, right? So the loss is significant beyond just what you lose initially, because it's like, well, I need to double my money to get back to where I was. And then on top of that, I have to also make up for the time I lost. And now I'm not saying you should think about it that way in the sense of, oh, I need to make this money back as quick as I can, I should double down, because that can oftentimes be, gambling, I'd say. But it's sort of thinking about the opportunity cost during that period, because if I went with opportunity A, which is, yes, I know this business is going to have a lower return because it's still a good opportunity, but it's somewhat priced. There's less uncertainty with it. And whilst it's still a great company at a good price, there's less uncertainty with it. So, it's not going to do major returns, but it's also not going to give you major losses, right? Whereas you might come across an opportunity and go, actually, this opportunity, yes, if the business doesn't handle its finances well and the market takes a turn, could lose 50% of its value like that. But if it pays down its debt that it has significant leverage on, the business could triple, right? Well, then if you think, well, yeah, you could have potentially tripled, but then you could have also lost 50%, had to double it, and then had to make another 50% back, it doesn't then seem as attractive. So I need to make sure for myself I'm not falling for the fallacy of, well, it's only a 50% loss, because it's a lot more than that. Whereas the other business, actually, what I found in my personal experience is, whilst the return profile seems a lot lower in reality, for me, it has actually been higher. I've actually come out oftentimes better on these opportunities because I think other people start to realize that over time as well. Particularly as there's always, business is never perfect. There's always usually something that goes wrong, where at least the results aren't as good as you anticipate them. For example, it could be growth slowdown. It could be a new variable that you didn't factor in. And these other great businesses generally still do great, at least good, right? And you do quite well off them. So for me, I think I know which for me is sort of the more favorable option. And that's sort of why I've been sticking away from unprofitable businesses. That's my general rule of thumb. Now, that is only a rule of thumb. So you'd have to give me something so obvious, so blindingly obvious, that it would be worthwhile for me to invest in a money losing company. And that may mean that the business is losing money, but the asset value, for example, is so high that even if the business goes bankrupt, I will still do well because the net asset value that the shareholders will get paid out on is so high. So, for example, I don't know if you had a tanker business with, I've used this as an example before, $300 million worth of tankers. There's $100 million worth of debt across the entire business. If you basically cancel those two out against each other in a sale, then you're left with about 200 million. Even if you said 150 million because it's a fire sale, you need to rush it, right? And you're not necessarily going to get the best prices. But if the market cap's only 50, 60 million, that's still a great deal for you because as an investor, you're tripling your money. Now, would you have probably made more money in the long term had the business stayed alive? Sure, but you're still doing very well. So, I mean, even then, like, yes, it's an unprofitable business, but the downside is still low. So I'm still not really having that risk. Yes, in theory, anything can fall 50%, right? But intrinsically, I know from the value of just the business and the assets that it's a great deal in that sense. So that's sort of the answer between why I would never buy an unprofitable business. And even if it was an unprofitable business, it's still, you can't class it as profitable, but the assets themselves are still very worthwhile, and that it's still not much risk there because it's so well priced in that, like, it's fine. It makes up for it. Another example that I sort of read on Value Investors Club is this business that basically had, I think they were trying to do some like pie in the sky idea of flying cars or something. I forgot exactly what the business was doing. Wasn't that relevant? I think it was losing about 100 million a year, maybe 50 million a year. This business itself was only valued, I think, about 400 million. But actually, I think they had an asset there. I think it was some sort of like network they had, this like bandwidth. I think they had like these assets that basically help with connectivity, right? Wi-Fi, internet connectivity. I think it was like to do with the cables. It was a long time ago. But the crux of the story on that one was that the asset actually turned out to be worth $1.5–2 billion. And after selling those, and this pie in the sky idea only required 10% of that amount. After selling everything else, you basically made 3–4 times your money just on that in itself. They actually ended up selling that early, and that sort of did very well. I think the stock went up like 4, 5, 6 times as a result of that. But it was just the fact that there was downside protection built in. So if you just looked at the pie in the sky idea that was losing $50 million, $100 million a year, you wouldn't have seen the investment opportunity there. But if you looked at the assets beyond that, you would have had an unprofitable business, but it would have been so well priced in that you would have done well. You can occasionally find these type of ideas in mining. Though in mining, I personally am a lot more cautious because there's 1,000 ways to die, not just 100 ways to die. And then on top of that, a lot of the times these assets could in theory be worth a lot more, but then once a certain restriction applies or something, you can get burnt very easily. But that could be an example. But I mean, oil tanker ships, for example, have been a very particular recent example because I think over the last year they had been very depressed in pricing. I'm not checked on them too recently, so they still could be, but in general, I did actually see a business which was sort of on my mind as to whether to invest in. I think they had a similar situation where they had, I think, about 150, 125 million worth of assets, tankers, so like assets that you could actually sell. And they weren't actually rated anything aggressively. They were like pretty conservative valuations. The net sort of debt, I think, position left them with about 110 million dollars. So after the debt, even if you are going to do the fire sale, you'd be left with 190 million dollars, right? And the market cap, I think at the time, was only like 40, 50 billion dollars. So like even if it was going bankrupt, you're still making like 1.5, 2 times your money, which I mean it was still good, but it just wasn't good enough for me. I think very stringent criteria in what I'm looking for, and I'm very picky. But like that is a real example of something I could have invested in, right? And you'd also be getting paid a nice dividend in the meantime, etc. And those sort of can add up, especially if it's like 7% a year or something higher than that, right? So I hope that was useful. Let me know what you think.